and welcome to the Cloud9Fin podcast, where we talk about all things credit, from performing to distressed. My name is Ayden Crosby. I'm a reporter covering distressed debt at 9Fin, and I'm joined by my co-host today, Rachel Butt, who's the U.S. distressed debt editor. We have a very special guest today with us, Jamie Sprayregen, who's the vice chairman of global strategy and growth at Hilco Global. Welcome to the podcast. We're happy to have you.
Thanks for having me.
Maybe to kick it off, I think for our audience, I was just wondering if you could talk a little bit about your journey to Hilco and what you're up to there.
Well, I've been at Hilco coming up on a year and a quarter-ish. My journey, I don't know where you want to start the journey. I could go from kindergarten, but maybe I'll start. I was a lawyer
later, yeah.
lawyer most of my career. I
Right.
joined Kirkland & Ellis in 1990, and I was a founder of the restructuring group there and built it up to, I think, what many regard as the largest restructuring group in the world. And I expanded it across the United States and into Europe and the UK and Asia, and stayed there most of my career, although I did leave in 2006 and went to Goldman Sachs to become an investment banker, and I co-ran their restructuring group. It was basically a rescue finance practice. I did that for about 3 years. And then I went back to Kirkland & Ellis in 2008, and I actually stayed there until I recently went to Hilco as I was reaching forcible retirement age at Kirkland. All good, totally supportive of the structure, and had a number of different opportunities of what I was going to do, but I ended up going to Hilco, and I think we're going to talk about why that is.
Yeah. As we understand, Oryx bought the majority stake of Hilco Global. Can you talk about what that means and what kind of expanded capabilities would that entail?
Yeah. So for any listeners who don't know, Hilco is a merchant bank, or you could say a financial services conglomerate. And we like to say we're asset smart. We understand the value of assets. The bones of the business has been our valuation, appraisal, and liquidation business, and knowing the value of individual assets, any kind of asset you can think of, whether it's retail or real estate or industrial or IP or receivables or many, many other kinds of assets too. And that led us into the lending business also because, in essence, we were underwriting for lots of other asset-based lenders, and by providing the valuations and appraisals. And as a result of that, we went into other lines of business in both professional services and deployment of capital. But we were always capital constrained, and our capital was quite expensive. And part of the reason I joined Hilco is we were about to embark on a process to bring in a major outside investor, and that culminated with the closing of the Oryx deal on September 3. And the investment thesis there, simplistically, is Oryx is going to help make Hilco a bigger, better, faster, stronger business. And we basically divided into two different platforms and actually simplified the business structure as part of the closing. We have a capital solutions platform. One element to that is a asset-based lending private credit fund. And we also have basically a special sits balance sheet investing business as part of the capital solutions business. And then on the other side, we have our professional services business, which has a number of dominant market share, mature businesses like our valuation appraisal business, our field audit business. And then we do a lot of other stuff in the professional services business. And the plan is to scale those businesses, again, with help from Oryx's capital. So we've had very expensive and very dear capital for most of our existence. And Oryx helps us solve that issue by having much lower cost of capital and much greater amount. And we hope that's going to help us scale both the asset-based lending private credit fund and our professional services business.
And where do you fit into all of this? What is your role?
So my role is, as you noted, I'm vice chairman of global strategy and growth. I sit at the holding company. I'm helping to raise funds for the private credit fund. I'm helping to find human capital for the professional services business. Hopefully I bring in some revenue too and do some deals. and kind of be involved in overall strategy also.
And speaking of deals, in the current environment with where the economy is at, labor market, and what are the biggest opportunities you see out there right now for the asset-backed lending business?
Well, we think our thesis has been in the asset-based lending business from the private credit side. The vast majority of private credit has really been cash flow lending. There's been a move towards asset-based lending. We think there's going to be more of that, especially with what's been going on out there. And we think we're perfectly situated to do that because of our asset knowledge. So we think that's the cash flow lending will always be there, and there'll always be lots of that. But we think there's going to be lots more in the asset-based lending space in the private credit world. And in fact, we think Oryx agrees with us, and that was part of their investment thesis also.
I'm curious how we've seen sort of an uptick in private credit restructurings, and I'm curious what you make of the market there.
Yeah, I mean, look, you see a lot of speculation as to we've all heard the term cockroaches and
bring that up.
And other things. And look, I'm a deal guy and not a economist, so I kind of deal with what's actually happening more than predictions. And the things that have happened, do raise some eyebrows and do raise some concerns. Whether that's systemic or episodic, who knows? I will note there hasn't been a cycle, a real credit cycle in the private credit market since the asset class started expanding incredibly over the last 5-7 years. And there will be one. I'm not here to predict when that will be, but we all know there will be one. And the nature of the private credit business, some of the pros of it, but some of the cons of it is it's a little bit more opaque and amenable to kicking the can quietly than the other kinds of credit businesses. And as a result, whether there's more than meets the eye and more rot under the system, it might be an unknowable until it's a knowable.
Mm-hmm. Yeah, I think there are a lot of ongoing investigations or probes into these cases with allegations of fraud right now, like First Brands.
Look, we all know there's, in human history, we've never been able to eliminate frauds. Mm-hmm. And so there's always some frauds out there, and they're not discovered till they're discovered. And so, I can't predict whether there's lots more out there. Are there more frauds out there? I'm sure there's more frauds out there. We just don't know what they are yet. And, the nature of the type of things we've heard in some of these situations, really cause people to think through how much diligence and monitoring they've done in the past, but really more importantly, that they are doing right now and should be doing in the future. In the world of lessons learned, and it's early days in lessons learned because we don't even know what the lessons are. But I think people are, thinking that through.
Right. And are you surprised by all these big players that are involved in these situations? We got JP Morgan, we got some other private credit players.
No, I'm not really surprised. I mean, there's big players. And by the way, it's a tiny, tiny percentage of what they have going on. That's gotten in trouble. So in and of itself, that doesn't necessarily indicate anything. But there's some big players. There's some players that maybe other people haven't necessarily heard of. And there's a lot in between. And, that's the nature of when a company gets in trouble. You start, uncovering stuff, and everything's always obvious in hindsight.
Right.
Maybe more on the positive side. I'm curious.
That wasn't positive?
No. Oh, that was fun.
In my business, that's positive.
No, I'm curious if you think private credit lenders have any sort of edge in these situations, navigating when something goes south.
I think that's one of the advantages, or something you might say differentiators of private credit. from the broadly syndicated loan market in that obviously by definition, there's usually less players, although there's been some convergence in the bigger loans. But there's usually less players and less disclosure required. And as a result, you can deal with the borrower in a little room like we're sitting in right now, as distinct from having dozens of players. And that produces a different dynamic and a different ability to get things done. Now, at the same time, if you're like reporters and you're trying to figure out what's going on there, is you're not going to see necessarily defaults, but you might see PIK interest and you might see extensions and you might see other amendments. And by the way, they're not all public, but the things you do see you're going to see in a different way than in the BSL market.
Right. The default rates are not necessarily the best gauge of any troubling credits in private.
Eventually they are, but they're a pretty lagging indicator at this point.
Yeah.
And then, by the way, even in the BSL market, because of the LME transactions, some people classify those as defaults and other people don't.
Yeah. And your old firm is really pioneering the LMEs, creativity of it, and it's sparking interesting debates along the way.
Creativity is a good thing.
It is.
Speaking of creativity, I think we've seen a couple of new provisions crop up in loan deals that have cleared the BSL market. Voting caps is one of these examples. I'm curious what you make sort of these creative techniques that are coming very far ahead of a possible restructuring, and if they're here to stay.
Yeah, look, none of these are brand new techniques. You could say they're creative. They've been talked about for a while. It depends in it's sort of bespoke situations as to whether any of these actually get done or not, and if they do, how they get done. But I think I was a wrestler as a younger person, and there was a saying: for every move, there's a counter move, and for every counter move, there's a counter move, and so on and so on. And to me, there's a little bit of that what's going on here in the sense that these are responsive to what's happened. If you trace it backwards to, say, the co-op agreements and things like that. And so this is the market, kind of scratching their head when something happens in one situation, say, I'd prefer that not happen to me in the next situation. What could I do to prevent it?
Yeah. And another sign of the continued push and pull between borrowers and sponsors and creditors, we're seeing a lot of anti-co-op agreement language baked into these credit agreements. Have you seen any of that making their way into more bespoke, like private credit deals at all?
Well, again, I'm not the lawyer anymore, but I'm I'm seeing a lot of percolation of discussion of those more than actual things happening.
Right. Yeah. So far, a lot of buzz, but as soon as I made it to the press,
yeah,
they get killed.
Well, I want to shift gears a little bit. We've been taking a look at some companies that have gone in sort of in the distressed and stress space that have gone out to do ABS deals, sort of in lieu of or ahead of more traditional LME. I'm curious what you make of some examples are Altice USA and Zayo securitizing fiber assets. I'm curious what you make of the market for these type of deals. Is there a sort of is it a hot market or what's?
I think it's an interesting development. It obviously depends on the issue. We're having assets that are securitizable, or some of them are pre-securitizable by the private credit transactions being done that put them in a position to securitize later. But I think it's you could think of it as pre-LME or a way to avoid contentiousness with the traditional LME. I don't know how many are going to be able to be done because it depends on the situation with the company. But I think those are another tool in the toolkit that people are increasingly looking at, and they're a kind of an efficient use of both legal and capital structuring.
Mm-hmm. All right. And what about AI space? I feel like every day I read the news, there's something about data center financing. And that's another really hot space that I think most of the ABF market is really attracted to. And how do you guys play in that space at all, if any, or any ancillary services in that whole AI ecosystem?
Yeah, so we Hilco haven't been a lender into that space at the present time. We do have a lot of expertise at valuing assets that would surround that ecosystem. There haven't been any LMEs in that space yet, and so not even real restructurings or anything like that because it's such a hot. It's going the exact opposite way.
Right.
So we're watching it with lots of interest, but it's not an area we played a lot in.
Gotcha. But it's certainly interesting how they all different big players in the AI space structure their deals, and it's all very circular and interrelated in a way.
Yeah, I've read about all those. I would say that's not my space to have an intelligent comment on.
That's all.
And I know you guys aren't maybe as active in that space, but going back to what I was talking about before with this rise in ABS deals, I'm curious what you make of the protections that those lenders have and how they fare when things go south. I think the thesis being that these entities are bankruptcy remote.
Yeah, I mean, look, if again, you got to make sure you dot your I's and cross your T's, and it's not just the thesis. That's the way those things are structured.
Right.
Everybody doesn't always do their documents correctly. I'm not saying anybody hasn't done anything correctly here. I'm not involved in those particular deals, but if everything goes well, nobody spends a lot of time reading the documents. It's only when the situations get a little bit stressed and then people fly-spec the documents and kind of pressure test whether there's any points in the documents that have some weaknesses.
Have you seen these types of deals converge in the private credit space at all? Is there an appetite for ABS in the direct lending market?
Yeah, I definitely think there's some convergence there. And that's one of the advantages in the private credit space. There's just a lot more flexibility in structuring. So you could do ABS, you could do what I call pre-ABS to put in a position to ultimately securitize. And so I think the private credit market is pretty friendly to the ability to do ABS.
Interesting. I mean, are there any sort of like quirks or idiosyncrasies there that are of note?
Well, as I noted, you need to have, you need to be kind of asset rich to be able to have the assets to put in a position to securitize. So I think that's, the sine qua non. And then, the structuring for the entire transaction is incredibly important. And yes, each situation has its bespoke elements to it.
And this is a bit of a pivot, but in light of the government shutdown, do you see a lot of opportunities out there to help middle market companies, like healthcare, for example, where insurance subsidies or the credits are at the heat of the argument?
Yeah, look, so far, the government shutdown, I would put air quotes around it because most of the government's operating. And which is part of the reason why the shutdown is continuing, because it's not causing the amount of pain that it used to in the past when the government actually shut down.
Right.
But the parts of the government that aren't operating can be incredibly painful. I've seen all sorts of estimates of, $15 billion a day in less economic activity is due to the shutdown. I don't know whether that's a true number or not. And I don't know how long this shutdown goes on, but the longer it goes on, there will be things that break and things that go bump in the night. Haven't really seen that yet. I've, again, seen speculation and seen, heard from some companies that have some angina and stress about what might happen if this keeps going on for a long period of time.
Right.
But so far, not a lot of impact.
Right. Yeah. We'll see.
Yes.
I'm curious how the impact of tariffs has played out since it's been half a year now since they were first announced. I'm curious what the market's looking like for you
Yeah, what I would say on that is it really hasn't been half a year. It's been half a year since the beginning of this. But
Right,
there's
right.
been a lot of toing and froing and ebbing and flowing. And if there's going to be, well, I'd say it this way, there's a lot of people say tariffs haven't been as bad as a lot of people thought, or the impact hasn't been as bad as a lot of people thought. And that is true so far. And it may be true, going forward. But the real impact of the tariffs is kind of feathering in now. We haven't felt the full brunt of it. And again, I'm not predicting some big wave or anything like that, but we are talking to a number of companies that have stress of varying degrees caused by the impact of tariffs, and a lot of it, the uncertainty of which way the tariffs are going to go, and the uncertainty can be worse than the actual tariffs themselves. And so there is, another stay tuned element, but I'd say there's kind of percolation in that space. And like I said, I'm not predicting some massive wave, but I do think there's going to be more fallout from that.
Are there any sectors, and I mean, this is discussed a lot before, but I'm curious your perspective on, any particular sectors that are more exposed than others?
Well, yeah, anybody who's bringing in goods, whether they're finished goods or, supply chain goods from places that are being highly tariffed, particularly China. And so, yes, there's significant impact on that. And that's what I'm talking about is what's kind of percolating. Thus far, people have been able to pass along some price increases, take some margin compression, push tariff impact onto the supplier from China or elsewhere, or more likely some combination of all of those things to kind of muddle through. And maybe they can keep doing that. I'm not here to predict they can't. But I think there's more pain to come and more muddling to come at a minimum.
Yeah, I mean, I think we've seen some stressors, tariffs, these couple of these bankruptcies that have cropped up that have caused concern, but maybe the impacts are further down the line, or they're maybe more diffuse than people anticipated. I'm curious what you make of just the state of credit for the remainder of the year.
Yeah, I mean, again, I'd say it's similar to what I said a little bit earlier, is that you've seen some bumps in the road and some cracks, but you haven't seen chasms. And from everything we're seeing and that I'm seeing from my own soundings, barring who knows what events and who knows what changes to tariffs. So with all the caveats I can muster, if we stay kind of steady state, I think we will see in the restructuring space, there'll be, kind of a steady drip, but not like some stream or wave. And that's consistent with why you're seeing a lot of liability management transactions over a long period of time. And a lot of this is still not only coming out of COVID, but coming out of what happened post GFC and the capital markets being wide open for a decade pre-COVID, and people being able to access credit and also have a lot looser credit documents, and also being able to access lots of credit courtesy of the government's fiscal largesse during COVID. And all of those things pile up. And most companies are able to grow into their leverage, and their capital structures accommodate ultimately the leverage that was taken on. But there's a subset that is going to need help from people who help in those situations.
Well, we'll be at the forefront of identifying those opportunities, hopefully.
I've read about that.
I know we're also nearly in the year end. So what are your predictions for 2026 credit markets?
Well, I think I'd say more of the same of what I just laid out. Barring, again, some exogenous event or shock, you'd see kind of a steady drip. I'd put a big asterisk on there because, I've said you mentioned the date of the tariffs. It was April 2, I remember, because I always say it was the day after April Fool's Day. And I had that exact prediction pre-April 2. And then, there was a huge market reaction for the few weeks after that, but then it kind of steadied out. And as I'm saying, with all the toing and froing of the tariffs, you've had an elongated period in which the impact was being feathered in, and you're going to feel that coming into 26. Again, I don't think that right now that's going to create some huge wave of problems. But you have some people smarter than me predicting, flat growth, some people negative growth, some people using the R word. And, if those things were to happen, there'd be, a lot more tumult in the credit markets and things will tighten up. So far, that doesn't feel like where it is, but I'm always loath to have too many predictions.
All right. I think maybe we can start to wrap it up there. I don't know if you have any other questions.
No, but since we're on camera, maybe Jamie can show us some wrestling moves that we can.
Yeah.
A beginner's wrestling.
I can do the fireman's carry. I'll skip.
Okay.
Thanks for having me.
Yeah. Any last words before you? Anything else?
No, I don't. I would just say thank you for having me, and always interesting to talk about what's happening in the credit markets. And I'm sure whatever predictions I've made here will turn out to be wrong.
Yeah.
We'll fact check this a year later.
Yeah.
Stay tuned.
All right.
Thank you, Jamie.
Thank you so much.
Thanks
everyone for listening.